keep the conversation going and join me here on the floor, Rebecca Walser, President of Walser Wealth Management. Thanks so much for joining me. What do you make of the action we're seeing today? Because we've certainly lost some momentum throughout the course of the session.
I'll tell you, the mood here seems very subdued and quiet, right, Sam? It's a Monday, a cold Monday in New York City, and it's not a happy day. You know, I think Jefferson's comment today at Kansas City just really underscored that the Fed is in a rock and a hard place. And really, they don't have the data. So my contention is, and also if you look at the actual market odds, right, we had over a 60% and approaching 70% probability of a December 9, 10, 25 bip cut. And now we're seeing that has shifted. The majority is now 55% that we won't get a cut at all, and that will only 44% probability that we actually see a 25 bip cut. And what I have noticed is a lot of the governors, a lot of people that are speaking are sounding very hawkish. And I would put Jefferson's comments today, underscoring the need to proceed with caution, go slowly, is hawkish. But what do they have in their back pocket? They have the data that's coming. So we have the jobs numbers for September coming out on Thursday. We have more data that we'll get before the December 9-10 meeting. And I think what they can do is that they can say, oh, we've gotten more data and it's not good for the economy. We need to become more accommodative. And they might be able to pull more of their members towards more dovish than hawkish. The problem is that they are facing dual mandates. And you look at the layoff situation, like Verizon announcing the largest job cuts ever in their history just last week. You're looking at other large employers announcing very large layoffs. So they're dealing with that, and they want to accommodate that. But then they're also dealing with the sticky inflation, the tariff policy being implemented, and all of these things. So they don't really know. And really, Powell doesn't have a consensus. If you look at the 19 members last month, only 10 were, really in alignment with an actual cut. So that means that you have a very divided board and group, and he does not have a consensus. And so unless there's clear data around which way to go, we're going to have a division, and it's going to be difficult.
Yeah, I suppose the division is no surprise there. I mean, you've got Jefferson, as you say, who's sort of as steady as she goes. You've had Collins and Schmid, who have basically said that, they're a bit reluctant moving forward. Kashkari sort of just sitting on the fence. So, yeah, it's going to be a very interesting meeting. Let's see what the data tells us. But, yes, there has been a rethink in the market. I mean, if you take a look at the CME Fed Watch tool, we are below 50%. So, I mean, it could go either way. It could be quite a close call come December 10th. But what if the earnings holds up? I mean, what if we hear some good news out of NVIDIA and from the retailers this week about, how consumers are spending?
I mean, I think that will be positive, right, for the Fed. And I think that they just need more data. And they need to be able to plant their flag around something that is definitive. And that's the problem. We have competing data, right? We have slowdown in the jobs markets, but we still have sticky inflation from our numbers that and we are also missing numbers from that, right? Because we only got we only got the COLA adjustment for Social Security, and that's the only reason we even got data for Q3 on the CPI. So I do think that they're looking for something that is very transparent. I think NVIDIA, after the bell on Wednesday, will really help. Investors, I'm noticing, are going from, greed to fear very easily. Like this is a needle that is moving very, very quickly, and it's almost like it's a battle between the fear of missing out and the fear of, is this overblown? Is this not really going to live up? You've got a lot of articles coming out talking about an AI bubble and all those things, Sam. So there's a lot of consternation back and forth.
Let's talk about that. I think last time I had you on, I referred to the front page of the Wall Street Journal, and we were talking about that circular financing. I want to refer to the front page of the Wall Street Journal once again today, because they've got a front page article about just the spending right now and the debt, the eye-watering debt levels as far as how much some of these tech companies are actually borrowing to fuel their massive AI ambitions and this huge spending plan that they have. And if you look at the 2024 numbers and then the graph of 2025, it's quite significant. And one line that really sticks out to me is how they're spreading the risk, because what used to be initially something that they could fund from their own coffers is something that they're now turning to debt and private equity for. And basically, this is like sharing the love kind of thing. I mean, what do you make of that?
Well, I think the hyperscalers were primarily funding from cash reserves and cash flow. So for them, I think Oracle really turned the table. Oracle's the one that came into the mix and said, hey, we don't have this investment. We don't have this capital. We're going to either raise, we're going to borrow, we're going to do whatever. So obviously Oracle was sort of the beginning of that. And that is a little bit alarming, because when you do connect the dots, Sam, and you say, oh, this one is paying, OpenAI is paying, this one is paying, this one, it is very circular. It is bubbleistic, and I would call it prickly. Prickly in the sense that that we don't have true monetization yet. And so when you have these massive R&D and CapEx expenditures into something that's new and yet not yet fully monetized, it can be bubblicious, and that is problematic. And so people now are aware, though, and that's something that we can now start to dissect and digress and really say, okay, what are you actually able to raise? What are you doing from your just revenues that are just being generated from AI-related things? You know, I mean, it can't just be ChatGPT. It has to well go beyond that for the evaluations that we're having. The other thing I know I mentioned to you before, I was so happy to see utilities up. We have valuations that can't be actually realized until we get more energy. So that's another problem that we're going to keep running up into the energy glass ceiling. And until someone can address that dead on and say this is going to be this new source of data center, electricity and AI chip electricity and all of these things, we still have that energy ceiling, which is a big, huge problem that no one seems to want to really talk about.
Yeah, it does look like some of the more sort of influential kind of tech leaders are sounding the alarm, or that at least bringing this into the conversation. And I know Jensen Huang has touched on that a lot, and he's made the comparison with China as well. But getting back to sort of the 30,000-foot view on the markets right now, I mean, we've heard some sort of new bullish calls, the likes of Morgan Stanley. I think it was Mike Wilson today, the S&P 500 looking for a 7,800 by end 2026. I mean, what gets us to these kinds of numbers? I mean, there was a lot of sort of bullish calls on where would be year end, and we're just sort of weeks away from that with a lot of volatility in the market right now.
Exactly. I think to 7,800 is absolute perfection and actually exceptionalism. Everything has to go exactly right. Everything that they say AI is going to do, it has to do that plus more. We're not at 7,800 by the end of 2026, barring any kind of economic global disruption, which I believe is on its way. Macroeconomic disruption, definitely China, Japan, there's a tiff there going on right now that's kind of spurring out. So 7,800 is an analyst pricing an absolute, everything is real, everything is going to come to fruition, everything is going to be streamlined, and it's a straight up into the right graph, and I do not see that happening. And the frothiness and the prickliness, I'm describing this as a prickly feeling, like it's 2 steps forward, 3 steps back, a step forward, a step back. Monetization is difficult, and when you've got monetization in a process where there's a lot of issues, energy being one of them, it can't be perfect. It can't be perfect. So I think it's a mistake to go out and tell the public this is what you should expect, because as little things happen. We lost 2% on October 28, and people were going to extreme fear. And that's the problem, is like there's no rooting and foundation of reality that this is really, really valuable and tangible, and it's worth something, and let us show you how. It's all hyper, futuristic, and for that reason, people do not know. I have to participate, but actually, oh my gosh, I can lose 2% in a day if China says they're going to be protectionist on rare earth minerals. Let me pull back. I'm going to get really scared. So you're not going to get straight to 7,800 without a lot of machinations of investors saying, oh my gosh, this is a scary ride.
Yeah, and what do you make as we're sort of on this whole theme of 13F filings, particularly around what Michael Burry has been doing with respect to some of his posts and sort of accusations throwing, talking about what the hyperscalers have been doing and that bringing that into question around sort of depreciation. I mean, do you sort of give credence to all of that as far as the conversation that's now being brought in?
It reminds me of the law, because I'm a lawyer too, So Michael Burry, he's obviously saying is like, look, these chips are only 2 to 3 years. They only have really useful life of 2 to 3 years, and they're being depreciated over 5 to 6 years. That is a big problem. But generally accepted accounting principles, what we call GAAP, it can't keep up with AI, right? This stuff is not new. This is all brand new. We have no idea. The new generations, successive generations that are coming out are replacing the old generations, and GAAP doesn't change that fast. So to say it's fraud when they're doing what generally accepted accounting principles are, because the utility of AI itself is going, becoming obsolete so fast, is a little a bridge too far for me. However, his point is not invalid. What he's saying is, because you are depreciating these things so fast in their useful life, you really do have less earnings and less revenue than you're saying, because you should be depreciating these assets. What's interesting is that he's now closing his hedge fund. At the end of the year, he's liquidating, and he basically said, I do not agree with the valuations of stocks. I haven't agreed with it for a while, so I'm done. I'm liquidating. And that is a massive statement for someone like him to say.
Yeah, and it's certainly something to pay attention to, just given obviously how high profile Michael Burry is. But always a pleasure speaking to you, Rebecca. Thank you so much for joining me here on the floor, albeit on a down day. But what can we do?
Yeah, I know.
Thank you so much. Rebecca Walser, Wealth Management, joining me here on the trading floor at the New York Stock Exchange.